In today's video, I'll be revealing the top 5 objections to cash value life insurance along with my responses. Hey folks, I'm David McKnight, best-selling author of The Power of Zero. One-size-fits-all financial gurus like Dave Ramsey, Suze Orman, and Clark Howard love to slam cash value life insurance, but are their criticisms always on target? Let's take a look. The number one most common objection I see from the aforementioned gurus is simply this: cash value life insurance, or what I refer to in my best-selling book, The Power of Zero, as the Life Insurance Retirement Plan, or LIRP, has high expenses. They love to fixate on the expenses in the early years of the policy and extrapolate those expenses out over the life of the program. That's a little bit like looking at your mortgage in the very first year and saying, look at all the money that went towards interest. I'll never pay off my house. The truth is that if your LIRP is structured properly, those expenses rapidly diminish over time. I've long said that if you're not planning on keeping your LIRP until death do you part, you should never enter into the contract. So, instead of focusing on the expenses in, say, the first 5 to 10 years of the program, you should instead focus on the average expenses per year over the life of the program. For most people, that's going to be between 30 and 50 years. When you do, you'll find that your average expenses will be about 1% of your cash value per year over that time frame. You'll find that compares quite favorably with your 401k. Common objection number 2. I can get a better return in the stock market. I've said this 1,000 times on this channel and elsewhere. These policies are not designed to get stock market rates of return. We're talking anywhere from 5 to 7% net of fees over time. The goal here is safe and productive growth. If anything, LIRPs are excellent bond replacements. Reach into your retirement account, remove the bonds, replace them with the LIRP, and you'll increase the rate of return, lower the risk, lower the standard deviation of your entire portfolio, and improve your outcome over time. LIRPs aren't and never have been in competition with the stock market. Common objection number 3. I won't need insurance when I retire because I'll be self-insured. I'm much better off buying term and investing the difference. Folks, 75% of the people I know over age 50 who enter into an LIRP do it not because of the death benefit, but because of the chronic illness rider. This allows them to receive their death benefit in advance of their death for the purpose of paying for long-term care. And if you die peacefully in your sleep, 30 years from now, never having needed long-term care, guess what? Someone's still getting a death benefit. Probably your kids or your grandkids, so there isn't that use it or lose it proposition that goes along with traditional long-term care insurance. By the way, if you don't think protection against a long-term care event is important, consider the following. If you should end up needing long-term care, all the money your spouse was planning on spending in retirement now gets earmarked for the long-term care facility. Your spouse gets to keep one house, one car, a minimum monthly maintenance needs allowance of about $2,500 a month, and between $30,000 and $145,000 of cash, depending on the state. So, what was turning out to be a pretty rosy retirement for your spouse turns into basic, bare-bones subsistence type living. Of course, the converse holds true should your spouse end up needing long-term care. That won't happen if you have an LIRP that allows you to receive your death benefit in advance of your death for the purposes of paying for long-term care. Common objection number 4. If your LIRP runs out of money before you die, you'll experience a taxable event. Folks, this one is true. You need to have at least $1 in your cash value when you die, or the IRS will send you a 1099 for all the taxes you missed out on along the way, and you'll be required to pay them all in 1 year. This is a big deal, folks. Fortunately, many LIRP carriers these days offer what's called an over-loan protection rider. That means that if through a combination of poor performance or over-loaning, your cash value reduces to a certain percentage of your overall death benefit, the company will take over your policy, pay it up, and make sure there's a nominal death benefit there for you when you die. If you manage your LIRP properly, however, it should never really come to this. but it's good to know there's a safety net in place if it ever did. Common objection number 5. You have to take loans to get your money out of your policy tax-free. In other words, life insurance companies allow you to take money out of your policy tax-free, but only by way of a loan. And here's the rub. Loans have interest rates, and everybody knows that loans have to be paid back, or so the thinking goes. Well, this is clearly an antiquated way of thinking. True, some LIRPs back in the day had loan provisions that could cost you anywhere from 2 to 8%, and if you didn't pay these loans back, the interest could quickly snowball and consume your LIRP's cash value. Well, fortunately these days, many companies allow you to take a 0% loan. In fact, there are even a few select companies that allow you to take a guaranteed 0% loan. That means your distributions from that LIRP are guaranteed to always be tax-free and compare favorably with a tax-free distribution from a Roth IRA. Folks, financial gurus like Dave Ramsey, Suze Orman, and Clark Howard love to throw out nasty objections about cash value life insurance, but when you put those objections under the microscope, they simply fall apart. Many of these objections are so dated as to be utterly irrelevant. Life insurance companies are nimble and have re-engineered their products to vastly minimize the historically negative facets of these policies and to amplify their positive attributes. And when structured properly, they can be an excellent complement to the other tax-free streams of income in your retirement portfolio. If you want to learn about other objections to the LIRP along with my answers to them, check out my best-selling book, Look Before You LIRP, on Amazon. And if you need some help finding an LIRP that aligns with the attributes I've discussed in today's video, head on over to davemcknight.com and click on the Work with David button. I'm happy to lend a hand. If you have any comments or questions, feel free to drop them into the comment section below. I'll respond to every single one of them personally. And don't forget to click like, subscribe, and the bell so you never miss a video. This is David McKnight. I look forward to seeing you on the next video.